What is up, YouTube? This is the Working Investor. In this video, we are going to compare apples to apples, large tech income-based ETFs, and we're going to compare it to the benchmark of the NASDAQ 100, basically ticker symbol QQQ. And we're going to see which underlying that are high tech cover call income-based ETF from a metric of a total return standpoint. Are they beating or coming short relative to the benchmark? In other words, are you leaving money on the table by opting for an income-based fund? Because as you guys know, I like to invest in income-based ETFs because when the fund provides income, it provides me freedom now and not some kind of value play hypothetically down the road where I have to cannibalize and sell some of the funds in order to live off. You could live off the funds possibly today. So we're going to use the funds I'm going to be basing this off will be two rec share funds. One is called Fepi and one is called AIPI, which is it's a little bit of a niche. So it's kind of like a AI play in tech. We're going to compare this to the Roundhill products called Qdte, and we're going to compare this to Ymax and Ymag in the Ymax ETFs, and we're going to use, as you see here, I'm using from June 4th because the most contemporary fund that came out was AIPI, and in order to have an apples to apples comparison, you want to look at number one, total return. And number two, you want to make sure you're looking at the same exact timeline. Otherwise, I don't think it's fair to look at an apples to apples comparison. These funds have different risk parameters, different risk profiles. So they're not all the same, but I'm just looking, if you want to look at just total return, how these funds have performed, that's what we're going to look in this video. We'll talk a little bit on how these funds differ. So you see here, the orange is the price return. That's one piece of the puzzle. And you can see here from June 4th, 2024 to November 23rd, 2024, it's about 5 months. It returned 11.32 in price return, but really the main picture we're looking at is the blue, which is total return, 11.65%. So that's going to be our benchmark. And I've done this for every single fund. I'm going to save you a little bit of time, and I could show it. I mean, you could go ahead and look this up on Seeking Alpha, but I just have respect for your time, so I won't torture you through this. So the QQQ is our benchmark, 11.65%. Again, it's the 100 largest companies in tech, the biggest movers in tech. Fepi really surprised me. Fepi is rec shares. They have basically a focus on big tech, and they basically rebalance monthly and they reconstitute quarterly. So if you go onto their website, I have the AIPI one open, but I can just, if you go here to the rec shares ETPs, you can go to cover call ETFs and look at Fepi, and they basically do cover calls. That's how they generate income. They like to target, I heard the fund manager talk about roughly 4.5%, 4.4%, somewhere in the 4 plus or minus decimal percent out of the money. They do about 30 days to expiration, cover call. They generate income and they actually own the underlying share. They write cover calls and they use that income to pay you. And they target 25% in income, but the total return picture could be a little bit different. And here you could see they've been paying $1.09, $1.08 to, a little bit over $1. And you could see here what they've been holding. Obviously, you could see here, they have AMD, Tesla, Google, Amazon, Apple, Intel. They talked about Intel. They mentioned that, obviously it didn't perform very well. But like I say, they rebalance this monthly and they reconstitute quarterly. You can see right here, they talk about quarterly reconstitution. So if something if they have anything that's not performing, they reevaluate if they're going to take it in or keep it or exchange it for something else. Micron, Netflix, Broadcom, they have a lot of these companies. So that's what Fepi does. And unfortunately, in a total return standpoint, it didn't really, and I'll even prove it to you. I mean, if you want, I could show you right here. Type in Fepi, and we won't go through every single one, but You just go to charting and you just go to select metrics, type in TOT and then look for total return. Make sure you push that button and then make sure you look at the same timeline. So we're looking at June 4th. If you press June 4th and just press apply, it'll go until today. And today is November 23rd. So it totally underperformed in the past in this timeline, 8.35%. So to go here, QQQ, the benchmark is 11.65. So I want to at least match or beat this benchmark and get income. Can you have it all, right? And I think it is possible. Now look at their AIPI. This is the one that, so I was really shocked with Fepi that it underperformed, but their AIPI, which is their AI, like artificial intelligent focus funds, their fund that focuses artificial intelligence stocks, they performed a whopping, they're the winner from everything here. They performed 15.29%. Again, they rebalance monthly and reconstitute quarterly, but you have to look at something called a risk-adjusted return. Remember, you're focusing mostly on the AI play over there. That's the, but, we could talk about, we're going to get to Qdte, which is also the entire NASDAQ as well. And that's, the same exposure as the QQQ, just with a different strategy. But let's talk about Ymag and Ymax. So Ymax, they have a special ETF called Ymag, like Ymax Magnificent 7. So they focus on only the Magnificent 7. So Apple, Google, Meta, Amazon, Nvidia, Tesla. What else am I missing? Oh, of course, Microsoft as well. So you're only exposed to those Magnificent 7 ETFs that they have. They have their single stock ETFs on those underlyings, and they charge you a little bit of a higher expense ratio to have this nicely tucked into a nice ETF, and they're roughly equally weighted. Roughly, that's not perfectly equally weighted when I looked at the prospectus, and they do pay weekly. There's a 1 week lag, so they have they kind of spread out the distributions of each of the single stock ETFs. And whatever they pay for certain ETFs, you're going to get paid that payment, the following week. So that's Ymag. And then we got Ymax. So Ymag got 13.89% in a total return standpoint in this exact time period, which is pretty impressive. But Ymax, it's a different type of risk profile because they're basically a composition of all of Ymax's 20-ish to 30-ish, somewhere in the 20 to 30 cover call ETFs. So they basically, it encompasses the 7 ETFs from Ymag, but you also have your risk kind of spread out between a bunch of other stuff, like some Bitcoin ETFs like Misty or Coney, I think they have Ybit, and they have a bunch of other Bitcoin related ones. They have some other sectors. They have a gold ETF. They have all kinds of different sectors. So it encompasses everything they have, some good ones, some bad ones. It's a whole mix. So it's a different type of risk profile. Some like it, some don't like it, but their total return has been a little bit less, 12.45%. So that's, and again, the same idea. They basically are approximately equally balanced, and they pay weekly with a 1 week lag. Qdte was the second best from what I've compared. Qdte, as far as total return, I'm not talking about the dividend yield, I'm talking about a total return standpoint. Qdte provided 14.75%. Now, bear in mind, every single one of these funds, except for Fepi, beat the QQQ, beat the NASDAQ. They've not pulverized, but they beat the benchmark, except for Fepi. Fepi fell short. But all these, I cannot tell you that they're bad funds because they beat the NASDAQ. And Fepi is also arguably not a bad fund. I actually own Fepi, though right now I'm thinking, because of looking at this data, I'm thinking of maybe betting on a bit of a faster horse for my taste. But some people don't have any issues with it. And there's nothing to knock somebody getting 8.35% in about 5 months. That's still pretty good. But I'm just showing you which ones so far have proven in these past 5 months how they're doing. So Qdte, they do 0 days to expiration. So most of the time, you'll quite see if you're a guessing person, a 0 day to expiration option cover call ETF has the potential to outperform the underlier just because of the premium that it collects. Because it's 0 day to expiration, they collect massive premium. Because let's say if a fund, let's say you could squeeze out $5 in one day to expiration, you would think that in 30 days you would have 30 times 5, so $150, but that's not the case. I'm just giving you a hypothetical scenario. If you went 30 days out, maybe you would collect, instead of $150, you'd only collect $100. So because when you get very close to the expiration date, the options, the premium decays as fast as possible. And when you're selling options, you're selling time, and you get the most value for your time. So in other words, you get the highest salary when you go closer to expiration. Contracts that are very close to expiration. If you're selling a 30-day or greater, it's like you're giving them a wholesale price. You want to give them the retail price of your hours, of your time. So just for an example. So they tend to do pretty well. That's why I love the 0 day to expiration options. Also, if there's a massive move in the market, because they adjust their strikes every single day, if they miss out on one day, they were a loss in one day, the next day it's a fresh day and they could go ahead and reset their strikes. So I like it how nimble and how elastic they can be. So Qdte is a roundhill product. They have 0 day to expiration with overnight exposure. So there's something called gap up, gap down in the market. You ever notice when a stock closes at a certain price at 4 p.m. Eastern time, the next day all of a sudden you notice it changes, like it's a significant bump up or bump down, especially if there's earnings, because the international markets are trading in those hours. So this fund tries to give you exposure overnight, because they're betting that statistically you may have more gap ups than gap down, because it could work against you when you have this overnight exposure. So they have performed 14.75%. So they have been the second best, but you don't have to sacrifice going just for an AI sector, like a subsector of tech. This is basically the same, so they all have different risk profiles. I would say, don't trust me. I'm not a financial advisor. Just look at the prospectus, read through it, all the risks associated with each of these funds. Talk to a financial advisor, see what makes sense to you, see what tax ramifications these funds have. Some of them have return on capital. Some of them have 60-40 tax profiling, where it's 60% long-term capital gains, 40% short-term capital gains. And for a lot of people, that's better than having 100% short-term capital gains. So speak to a tax advisor, speak to an advisor, see what happens. I want to thank you for getting to the end of the video. So I'm going to show you bonus content over here because you guys stayed to the end. We're going to compare a global income ETF. So there's something called, I'm going to compare it to the VT. VT is the Vanguard Total Index. They have something called VTI or VT. And there's something called GIAX. So let me get to you over here. So this is, so this is called VT, and I used to own VT, Vanguard Total World Index. You buy this one stock, this one ETF, and you get to own the world. We're talking about domestic and international. And of course, you have to look very, you have to scrutinize exactly like what percent, what sectors they're holding in which countries. So, you can have two global funds and they could be similar in a way, but completely different. And of course, their expense ratio with Vanguard is very attractive. We're talking about 0.07% expense ratio. And this one is not an income-based ETF, but I'm going to use this as a benchmark because I'm going to compare this to something called GIAX, which it's a one ETF that is completely spread out between domestic and global. mostly domestic, but it does give you income. So I'm going to use this as the benchmark. It may not be the best benchmark, but here I was trying to show you. This is basically a large cap blend, and basically, if you go to portfolio composition, sorry about the up and down, you could see here they have 93 billion under. Well, that's the median market cap. But if you go down over here, they show you a nice diagram that it's a large blend. So it's between a mix of growth and value, but mostly large cap, pretty much large cap. And then here you could see that their breakdown of, 10% emerging markets, 14.3% Europe, 9.4% Pacific, a little sprinkle of Middle East. Obviously, mostly domestic, mostly North American, which I guess North America could include Canada as well. That's part of North America. So 66%. And of course, you see that even though it's a global company, you can see that their highest weight is the Magnificent Seven is pretty much, almost their entire weight, the biggest weight of it. So we're going to compare this, and we're going to compare it to something called GIAX, which I made a video about. So the GIAX does call credit spreads. It's a different type of option strategy where they derive income, and this is where they're exposed. They're basically exposed to the S&P 500, the Russell 2000. I did see, they have the mid cap growth, the dividend appreciation. So we're going to deep value. There's also, Argentina, India, Freedom 100 emerging markets, just like you saw, there was emerging markets in the Vanguard. And what does that mean exactly? You have to break it down. They also, when I looked at the prospectus, see how they have Taiwan Semiconductor. So they also have the ability, and Adian. They also have the ability to write their own individual options on single stocks as well. Whenever you work with single stocks, there's higher risk, but there's higher reward. So they have this flexibility from going really zero in to, they can go all the way to the trees or zoom out to the forest. So yeah, it's pretty much you could trade in a lot of different platforms. So let's get to the numbers here. So the VT basically, and we're looking at a time period since GIAX has data on Seeking Alpha. So July 30th, 2024, that's as most data I can gather from GIAX. So they just launched a few months ago until today's date. And you can see here that GIAX as a total return nearly matched VT. I'm using VT as my benchmark. Maybe it's not the best benchmark, but it reminds me of VT. So, but if you have a better benchmark, let me know. So they're very close to the benchmark, only about 16 basis points in a total return standpoint behind. So I would say that the fund is doing pretty well if it's very close to the benchmark. Just my opinion, again, just a retail investor. Anyways, I hope you guys enjoy. I'm thinking of making a video of comparing, let's say, the XDTE, QDT, RDT based not against each other. It's not fair to base them against each other. I would say to compare them against its benchmark, against the index, because you can't compare. If you go shopping in the store, you buy an apple, you buy a banana, you buy an orange. You cannot compare the apple to the orange to the banana. That's not fair. They're totally different fruits. But you could compare banana to banana and see if you got a good banana, an orange to another orange and see if you got a good orange, an apple to an apple, maybe even the same type of apple. You know what I mean? When you compare like with likes, then you could see, because they have different risk profiles for risk adjusted return and different preferences that people have. So I am looking into making a video on those ETFs. I do have a video that I made. I'll put a link that I compared the S&P exposure indexes. So I'll make a link over there, especially when it comes to income-based funds. Anyways, I hope you guys have a wonderful weekend. This is The Working Investor, over and out. Be well.